The Federal Reserve announcing another 75 basis point rate hike today. But what does this hike mean for investors and their bond portfolios? Joining us now to discuss is Alex Morris, FM Investments President and Chief Investment Officer. He joins us as part of our weekly ETF report brought to you by Invesco QQQ. So, Alex, when you take a look at the reaction that we're seeing play out in the bond markets, yields on the 10-year Treasury moving to the upside once again right now at 410. What's your takeaway, I guess, from what we just heard from Powell and what this means here for investors?
Well, I think the chairman makes a good point. None of us have a crystal ball. I read the statement before coming here, and everything looked fine until the press release happens. And I think it's pretty clear rates are going higher, and they're going to stay there for a while longer. And long term, I think the Fed is making clear they will get a handle on things. So things will come back to normal. It's just going to take a while. And that's more or less what we should expect. These things don't happen on a dime, and when they do, we all get very nervous and overly excited.
So then, Alex, for retail investors who are wondering how they should be approaching Treasuries right now, talk about the ETF and some of the ways that they can get into this, perhaps if they're a little bit risk averse.
Sure. So first of all, we built the ETFs because investing in Treasuries is a tried and true strategy, but yet remains stubbornly difficult for most investors, retail advisors and otherwise. They trade in fractions, they have messy cash flows. They're not as simple to trade as stocks for a variety of reasons. And we built these single Treasury ETFs to make that much easier. You know, folks start looking at the yield curve and they start looking at all the various issues, and it becomes very complicated very quickly. So as you start to look at how do you want to approach this, you want something that has security of a Treasury, but you don't want to make a mistake in how you invest in it. So we built access to the most liquid, most straightforward Treasuries today, which are the on the runs. Folks who are really looking for short-term havens really should look at something on the shorter end of the curve, which is for us the 90-day product. And those who want to take a much longer-term view on the economy and where the Fed will ultimately land things should look towards the farther end of the curve, which for us is in the 10-year product.
So when you take a look at demand right now for these funds, what we're seeing playing out, given the fact that it is such an uncertain environment, I guess if people are second guessing what they should be doing when it comes to investing in Treasuries, what's one or two things you would advise them to take into consideration?
The first thing we tell everyone is this too shall pass, right? Mm-hmm. So not to fall off in long-term asset allocation or long-term game plan. Timing the market never really works terribly well. But if you're more worried about short-term movements, stay on the shorter end of the curve, continue to remain invested, but don't think this is the opportunity to try to outrun the market. You won't be successful, and if you do, it'll probably catch up to you pretty quickly.
And Alex, you said that Treasuries are, quote, finally interesting again. Talk about this period that way and give us some context given how we've historically seen the market move.
Sure. So for the last little pre-2008, Treasuries had a long history of being somewhat elevated. Then all of a sudden we entered a decade of zero interest rates, which is something that hadn't really been seen or thought of before. And many investors have come up and gotten used to relatively low-cost capital that can fuel all sorts of things in the bond market in new and interesting ways, as well as the equity markets, which we certainly saw in the past decade. Now as rates go up, and we look backwards, 20 years ago, rates were higher than this, and certainly in the 80s, substantially higher. So now as we move rates up to try to destroy some demand, as Chairman Powell made very clear, now we have to decide how do we get access to yield as well as have some negative correlation, at least historically, to the equity markets. Traditionally, that's been Treasuries. Certainly credit spreads have started to widen but haven't cracked yet, which is still a good sign for the bond market. But for those who have been risk on and now are looking for a safe haven, Treasuries have traditionally been that location to go to, and we built products to make that easy to access.
Access certainly important, especially for retail investors trying to get a handle on all these movements. Alex Morris, thank you so much for joining us this afternoon.